thank you to everyone who's joining us this morning, taking time out of your busy day. I'm Liz Rains, and for the last couple of months, I've been helping the Alaska Press Club put together some professional development opportunities around the legislative session. Today's session is called #AK Covered Beyond the PFD with Angela Rodell. And for anyone who's not familiar with Ms. Rodell, she is the Chief Executive Officer of the Alaska Permanent Fund Corporation, and she's also a former Commissioner of Revenue for the state. She previously served on APFC's Board of Trustees as a cabinet member and is currently the Deputy Chair of the International Forum of Sovereign Wealth Funds. And this presentation that she'll be giving today, it's presented by Alaska Press Club in partnership with the Alaska Center for Excellence in Journalism, with support from the Atwood Foundation and Knight Foundation in partnership with the Rasmuson Foundation. So Alaska Press Club has received quite a bit of support to put on these presentations. And this is one installment in this series called AK Ledge Covered. If you've missed any of our other sessions, we've had 3 previous sessions that are also available on the Alaska Press Club's website. Those former sessions included a presentation by the legislature's librarian, Jennifer Fletcher, on legislative research, as well as a presentation by Larry Pursley and Tim Bradner on how to read state budgets, and also a presentation by former educator Chad Sant on some legislative basics. So you can find all those prior installments on the legislature's website, and this installment will be made available there as well. But we've invited Ms. Rodell here today to talk a little bit about the Permanent Fund's mission, some resources for keeping track of fund activity, and to help walk us through the role that the Permanent Fund has played in funding state services in recent years. And we want this to be an interactive presentation. Ms. Rodell wants it to be engaging with our participants. So if you have a question, please feel free to, you can type it into the chat box that is located at the bottom bar of Zoom. And there is also an option to, there's a Q&A box where you can type a question anonymously if you'd like. So that's another option there as well. But please feel free to chime in with a question as it comes up. And if Ms. Rodell has already moved on to another subject, we'll hold it for the end, but we'll make sure that we get that question asked for you. And be sure to stay tuned to the end, because we will have one trivia question for all of our attendees and a chance to win some Alaska Press Club swag. So without further ado, I want to go ahead and hand it over to Ms. Rodell so she can begin her presentation. Ms. Rodell, thank you so much for joining us this morning.
Oh, thank you. And it's a real pleasure to be with everybody today, even through this virtual setting. We were talking about how a year ago, the pandemic hit, we all went to work from home. The Permanent Fund Corporation is no different. We've been working from home since March 24th, and all the new skills we've learned, and here we are doing things like this, which will never be rolled back. And I think it's fantastic that we can do things like this, and especially spread the word. So, and I appreciate the opportunity to talk about the fund and to get some notes out there for all of you. We do have a slide deck to share, and I always start these conversations with where did we start? To understand sort of where we're going, it's always helpful to understand where we've been and what we've done. And the debate began in 1969 with the first lease sales, and we received over $900 million for those Prudhoe lease sales in 1969. So you can imagine how in 2021 dollars, the magnitude of that sale at a time when the FY70 budget was a mere $173 million versus the $5 billion we might have this year. And there was a tremendous amount of needs. That $900 million was spent very quickly, and the state was very concerned about being able to keep up, and how do we transition away from a boom bust cycle? Alaska has a history of boom bust cycles, whether it's fur trade, gold, fish, and now oil and gas. So in 1976, Alaskans voted in favor of amending the Constitution. You know, this took a 2/3 majority of both the House and the Senate, the support of a governor, as well as Alaskans, to adopt this language into law. And the language is very simple and it's very straightforward, that at least 25% will be saved and that all income will be deposited in the general fund. But the only, use of the savings can be to invest. And so this created this perpetual in perpetuity fund, a permanent fund that would generate income for the state of Alaska long after it was viewed that oil would no longer be able to serve that role. We here at APFC were established 4 years later in 1980. And our mission is to manage and invest the assets of the permanent fund. We do have other funds that we manage at the request of the state. We have the Alaska Capital Income Fund. This is funded by settlement proceeds from the Amaretta Hess case. And we also manage money on behalf of the Alaska Mental Health Trust Fund. But the vast majority of assets under management are the principal and earnings reserve account of the Alaska Permanent Fund. And our vision for ourselves is to make sure that we deliver outstanding returns for the benefit of all current and future generations of Alaskans. We are governed by a 6-member board of trustees. They are governor appointed. They're on staggered 4-year terms, along with 2 commissioners. One must be the Commissioner of Revenue. And as fiduciaries, the trustees have a duty to Alaskans in ensuring that the fund is managed and invested for the benefit of all generations of Alaskans, to maintain the safety of principal while maximizing total return, and to allow for the maximum use of disposable income from the fund for the purposes designated by law. And that is our duty. We don't have anything beyond this. This is what is within our purview to manage and to do. If we go to the next slide, that investment management responsibility really comes from 2 sources. It comes from a constitutional mandate and from statutory mandates. So the principal does provide that permanent savings mechanism. The earnings reserve account was created to hold all the investment income and is available for appropriation. And we've put in place through statute and through regulation, prudent rules to govern saving, spending, and growth. Our stewardship is quasi-independent. So while we have tremendous independence in determining, for example, whether or not to invest in real estate versus stocks, to invest in stock A versus bond B, we still have a lot of accountability to the legislature, to the governor, and to the people of Alaska. Our horizon is really important. We have a long-term horizon. We are investing with an outlook that goes well beyond any current fiscal year. It requires that we do prudent diversification. We continue to have accountability, and we are good stewards of our resources. And it's really important to think about the corporation in context of managing this fund, because we're all aligned in that a robust, healthy, permanent fund is important to all of us, not just this generation of Alaskans, but to also future generations of Alaskans. So if you think about the fund as really being this renewable resource, we receive contributions. Those contributions are royalty, they're special appropriations, they're inflation proofing. All of that is invested. It generates income. The income is moved over to the earnings reserve account. So long as that money resides in the earnings reserve account, it will be invested similar to the principal in the same assets as the principal, generating its own income as well. And then it's used for APFC operations, our investment expenses, any inflation proofing that needs to come back, and the percent of market value that funds state government and permanent fund dividends. So honing in a little bit on the principle of the fund, the principle was constitutionally established as that permanent part. And as I said, it grows only through 3 mechanisms: royalty contributions, special appropriations, and inflation proofing. I think what's really important to note is what's not here. What's not here is market growth, unrealized realized, I should say not unrealized, but realized gains. There's nothing market related or investment related that causes growth of the principal. And it can only be used for income producing investments. Since that first deposit of $734,000 in 1977 through January 31st of 2021, we have received $17.7 billion in royalty deposits. This has been the constitutionally minimum required of 25%, along with statutorily mandated deposits of 50% for leases entered into after 1979. We've also received in the principal $18 billion in inflation proofing. The inflation proofing calculation is based on the balance of the principal along with a calendar year inflation calculation to determine how much inflation proofing. And then $11 billion in special appropriations. These are legislative deposits that have been transferred over from the general fund to the tune of $2.7 billion over the years, along with more than $8 billion coming from the earnings reserve account over the years. The largest deposit that has come was in fiscal year 2020 with the deposit of $4 billion from the earnings reserve account into the principal of the fund. The earnings reserve account was established under statutes as a separate account to hold investment income. It is to be invested in investments authorized under the same investments that the principal of the fund is invested in. And it grows through the receipt of statutory net income. And it's available for legislative appropriation with a simple majority vote, so 21-11. And I think one thing I want to note here is when we say it's invested in investments, it is invested on a pro rata basis. So every share of stock is owned on a pro rata basis by the earnings reserve account and the principal. The earnings reserve account does not have its own shares of stock. It does not have its own shares of bonds. It owns a piece of every asset along with the principal of the fund. Statutory net income is the result of investment activity, and it is monthly cash inflows from stocks. It is those bond interest payments. It is the rentals off of real estate. It's also the realized capital gains and losses. So all that net income generated by the sale of investments. So if we sell an asset at a gain, all of that gain moves into the earnings reserve account. As of January 31st, 2021, we've already in 7 months generated statutory net income of almost $3.7 billion. And I think this is important to note, and you can see this in the chart on the left-hand side of this slide, is that you might see markets move very volatile, a lot of volatility in the markets. The gold line represents total return each year. And for the most part, statutory net income may have a correlation, but it doesn't move in tandem with that line. So you'll see in 2018, when we had the sale of a large real estate asset that generated a tremendous gain for the fund, it was outsized compared to what the market was doing that year. And that's what highlights why statutory net income can move very differently some years from what the total return or the market value of the fund is doing. In principle, we have, as of January 31st, $57.8 billion in the permanent part of the fund. To show how much we've grown over the last 5 years, you will see that in FY16 on June 30th, we ended the fiscal year with $39.4 billion. So over 5 years, we've added $7 billion to the principal of the fund. And the largest portion of that was that $4 billion transfer that happened in 2020, that special appropriation. So I think what this highlights is just how difficult it can be without that inflation proofing or special appropriation for the principal of the fund to grow. It has associated with it now $11 billion in unrealized gains. Anytime we rebalance or we realize some of that $11 billion in gain, all of that money then moves to the earnings reserve account as statutory net income. In fiscal year 2016, we had 7.7 billion in uncommitted realized earnings and about 900 million in unrealized gains. Today, in fiscal year 21 to date, we have 9 billion in uncommitted. We have 2.8 billion in unrealized gains associated with that portion of 9 billion. And we have 3.1 billion set aside in anticipation of an appropriation of the fiscal year 2022 percent of market value. So we set this aside, we carved this out on our financial statements to let people know we're already planning this appropriation. This is a number that is already set in stone. It's not an estimated number or expected number. The only thing that would change this number is whether or not the legislature chose to appropriate something different than the 3.1 billion, or the governor took action to veto a portion of this 3.1 billion. And anything that isn't used stays behind in the earnings reserve account. It does not transfer to some other account within the state government coffers. One of the things that we provide is monthly reporting. And since our creation in 1980, accountability and transparency have been at the top of our values. In terms of making sure that Alaskans have complete confidence in everything we're doing. And so it's really important that we continue to publish accurate data for public consumption. Our financial and performance reports are produced monthly. They are only audited once a year. They are audited for June 30th, the end of the state's fiscal year, and they are audited by an external auditor, KPMG, and we have included in the financial statements those reconciled values for the principal and earnings reserve accounts. So as I said, each investment is owned on a pro rata basis, and so this is when we go through and divvy up. So if there have been draws out of the earnings reserve account, they will get a reduction in their ownership of an investment. If there's been contributions to the principal, they will get an increased ownership percentage of an asset. When you pull up our financial statements, the one that everybody seems to be most interested in is the balance sheet. And here's where you can see exactly what is happening with fund balances. So you can see how much assets under management we have. As of January 31st, we had assets under management of $76.4 billion. This compared to where we ended the fiscal year at $67.9 billion of assets under management. But we had liabilities associated against that. We had at January 31st, almost $3.8 billion in liabilities. A part of this is the balance of the fiscal year 21 percent of market value transfers that the state has yet to take. We work with the state to transfer over money based on their needs. It's a deliberate cooperative process, and they have about $1.091 billion left available to use, and they will use that over the next 4 months. And then we had accounts payable of almost $2.7 billion. A lot of this is potential trade. This is trade activity that hasn't settled yet, where we have to pay out money on different trades. And it just happens to be the timing with settlements. In fund balance, you'll see how much is in the principal of the fund. That is that non-spendable portion, and that gets us to that $57.7 billion number. And then the balance underneath that total non-spendable is everything that is found in the earnings reserve account. So you'll see our set aside for the FY22 % of market value. And you'll also see how much is available for appropriation, including any unrealized appreciation, unrealized gain that might be there. And this gets us to the total fund then of approximately $72 billion. So once you've taken out the liabilities, that's what the true fund, total fund balance is. So this takes about 3 weeks for us to put together at the end of each month. We have over 700 investment accounts, and each of those accounts can range from holding one real estate asset to several, to hundreds of public equity positions. You will also find on the financial statement values for the statement of revenues and expenditures. And what this really does is creates where you can see the movement of revenues. So if you look at the statement of revenues and expenditures, you can see we received interest, dividends, real estate income for 7 months of $659 million. That's that cash portion, that regularized cash portion that flows into statutory net income. You'll also see the change in value. So you'll see that, for example, we had stock that had a increase in fair value on June 30th of at the fiscal year end of $40 million. It's now swung in 7 months to $7.3 billion. That's where you see that unrealized gain just really generating value for the fund. So total revenues in accounting terms for the 7 months ended was $10.4 billion. And then for statutory, we have operating expenditures. This is our operations. This is, you'll see other legislative appropriations. This is money we transfer to pay DNR under those appropriations, or to pay Department of Law for collection of our royalties. And then finally, we get down to transfers in and out. And this is where you see the royalties come in. You'll see where we transfer out capital income. And then finally, the reconciliation to fund balances and how that income adds. Statutory net income is not shown here because this is true financial accounting, but you can find it at the bottom you can find it on our history and projections page that we also include each month. So here, this takes you to what you can find on our history and projections. We have, as I said, that statutory net income calculation on the bottom, so you can see how that is accruing over time. We also include on this page, which is really important, the calculations that people continue to ask for. How do we calculate the % of market value? What years are those based on? And what is the average value? And then what would be the distribution? And then also the statutory dividend transfer. The statutory dividend transfer is calculated on 5 different years than the POMV, and it's calculated on statutory net income, not %. It's not on the market value of the fund itself. So it has a very different basis and time period for the calculation. So the two can conflict at times, and you sort of see evidence of that in these calculations before you. All right. In terms of other information you can find on a monthly basis is the monthly performance. So to get a sense of both over time and in the short term, how we are doing from an investment perspective. And I think one of the challenges we have, there's a tremendous amount of information here. This is a 6-page report. you will find. And on the front page, you'll see the total fund performance for 1 month versus 5 years. You'll see the benchmarks we're measured against, and then you'll see each asset class rolled up, and you'll see individually, like, how did we do domestic equity in US equities? We've earned over 5 years 13.55%. If you look at the bold far right, compared to a benchmark against the Russell 3000 index of 15.4%. If you look at the 5 pages behind this page on our website, you'll see actual manager performance against their required benchmarks that they've been assigned. So there's a lot of detail that we publish each month that you can find in terms of whether it's individual asset class performance, individual manager performance, who those managers are in some cases, rolling up to the total fund performance. I think when we talk about performance, it's really easy at times to think about the monthly or the short-term data and what's happening in very real terms. The news headlines, as I'm talking to the Alaska Press Club about what's happening. And one of the things that we work really hard on is it's really important as professional investors to not get caught in the emotion of the day, but to really stay disciplined on our long-term strategies and our tactical tilts or tactical efforts that we're making. And it does mean maybe making adjustments in the near term on a weekly, monthly basis, but overall keeping the fund pointed in a specific direction. We have over the years had a lot of ability to adjust how we invest as Alaskans have gotten more and more comfortable with what we do. So in 1977, the fund was only allowed to invest in fixed income securities such as treasury bonds. If you look historically back in the early 80s, you could get overnight repo rates in excess of 20%. Bond yields were in the high double digits. You generated a lot of income at that time from having a fixed income portfolio. With the creation of the corporation, we were allowed to make our first investments into the US stock market, and later that year, indirectly held real estate. And then we were allowed to expand even further into bond and stock markets outside the United States. And the most important and testament to the skill of the Permanent Fund Corporation and the governance and the transparency with which we do things, the allowable list of investments was taken out of statute, and it was replaced with a prudent investor rule, and it was replaced with regulations as opposed to statutes. And you can see that's when the fund values really started to take off, because now we were able to get into higher yielding, returning asset classes such as private equity, such as private credit and infrastructure. So our asset allocation now has 8 asset classes. They range from public classes such as bonds and stocks and cash. We have a 2% allocation to cash, to illiquid private classes such as private equity and private income. If we go to the next slide, I think when we talk about the asset allocation, we've had a diversification benefit. The goal is to make sure that we have some asset classes that are not correlated, so that if one asset class fails to deliver return, you have other asset classes that can deliver return, especially in down markets. We included in here Callan's forecast for FY22 through FY31. This is something that the Board of Trustees will be taking up in May and they will be taking it up for the following fiscal year, and we will be making adjustments in light of Callan's forecast. Callan is not an outlier in their forecast. We are seeing this from a number of different entities that do this. And what's important to note is just the expectation, the forecast is that we are going to enter into a period coming out of the pandemic of lower long-term growth. So while we may have very high markets today, as with a lot of fiscal stimulus coming out of Washington and other central governments around the world to try and stimulate and help economies recover, that ultimately, if at the end of 10 years, so when we're here in 2031 and we look back, we will have seen a period of much slower, lower growth. You can see that the highest returning asset class expected to be for the permanent fund will be private equity and those growth opportunities at 8%. But cash is going to step down. Inflation is expected to step down. And so we're looking at a total fund return of 6.2%. And if we subtract out inflation, that's talking about real growth over the next 10 years of only 4.2%. So there's been a great reliance by the state over the last 3 years in particular on the Permanent Fund Corporation and our activities. And as documented by the Department of Revenue, we are the revenue generator now for the state of Alaska. We are providing or generating 71% of the revenue for unrestricted general fund in FY21, and it's expected to be 72% for fiscal year 22, and at least 67% of unrestricted general fund annually through fiscal year 2030. And if you think about that, and you think about that in context of where revenue has come historically, we have had a reliance on the oil and gas industry as a whole has provided the vast majority of that oil and gas revenue for 40 years. And now one entity, one company, the Alaska Permanent Fund Corporation, is covering more than any single entity in the oil and gas industry ever had to generate. The earnings reserve account is subject to legislative appropriation. It is used to cover the cost of investing and managing the permanent fund. It provides that really predictable revenue stream for current generations. We protect the value of the principal. It's our job to invest it for future generations, to make sure that there is something here for future generations, and to support, quite honestly, the state agency's collection of royalties to make sure that we continue to get that 25% minimum. If you look at the state budget and what happened with the fund and what we produced or what was used, you will see that what was enacted for fiscal year 21 was almost $150 million for APFC to operate and to pay those investment management expenses. We do have a supplemental request given the amount of positive activity the fund has seen over the first 7 months of the fiscal year of an additional $50 million. That's been included in the governor's supplemental request. There was a percent of market value draw of a little over $3 billion, almost $3.1 billion for FY21. The governor's proposed supplemental FY21 and his proposed FY22 budget includes both a $1.2 billion draw for the permanent fund dividend for FY21, little over $2 billion permanent fund dividend draw for FY22, and a full percent of market value draw for state services. So that totals a little over $6 billion that would come out of the earnings reserve account this year. We've received royalties. There are also royalty collections. So statutory royalties of 67.9 million, 41.4 million expected. This comes from the Department of Revenue and their forecast of royalty collections for FY 21 and 22. So you can see royalties are really important to us still, but they are such a small portion of what grows in the principal. They are not going to cause the principal to get extremely large going forward into the future. And then finally, you'll see the appropriations that were made for the agencies in collection of royalty on behalf of the permanent fund. The trustees have been concerned for a long time. In many ways, this dates back to 2020 about not just having prudent savings rules, but also having prudent formulaic spending rules. And their support of a concept of the percent of market value concept does date back 21 years to 2000, and is supportive of a constitutional amendment that would ensure no more than a sustainable amount was ever taken from the permanent fund. And creating that formulaic management of transfers into and out of the earnings reserve account does ensure sustainability and long-term growth of the fund. It allows the fund to have built-in inflation proofing growth, real growth to the fund, to ensure that it's around for not just the next 45 years, but the 45 years after that, and after that, and after that. And as you see the dependence on the fund, I think it's more important than ever before that we put in place these types of rules to ensure that we have this revenue resource for the state of Alaska. It is really quite exceptional what has been created here, and it just happens to be coincidence that the use of fund earnings, we've used 71.4 billion, ties to so closely to the amount of the fund balance right now. It's very close to the $72 billion number, but we have distributed, earned $33.8 billion that's either been paid out to the general fund for state services, or funded dividend to the tune of $24 billion. This is money that has flowed into the state of Alaska and has flowed into the economy of Alaska over the last 40 years. In addition, we've earned money that has then transferred into the principal and saved $26.3 billion, either through those special appropriations or inflation proofing. To have earned $26 billion and save that money as well is a huge accomplishment. And there is still left in earnings an unappropriated value of $11.3 billion. That includes that $8.2 billion of uncommitted earnings and the fiscal year 22 commitment of $3.1 billion. So it is really amazing to me what this concept created 40 years ago. And we are really fortunate to be able to do this for the state of Alaska. If you think about, has the corporation generated value for the state? And if you think about what sort of a cost value proposition, our operating request to fund our operations here at APFC is $18.8 million. $18.8 million. We generated in FY 2020 $3.1 billion in statutory net income. We're already at $3.7 billion in 7 months for FY 21. But if we look at FY 20, that means we we're averaging $12.3 million a day in revenue cash into the earnings reserve account. Means it took us just 1.5 days to generate enough revenue to cover our operating budget. It took us 10, almost 11 days to cover the allocation in the investment management allocation of $133 million. So it basically took us 2.5 business weeks to cover the cost of managing the fund in FY 2020. This year, it's taking us even less time to do that, given both market conditions and what we're able to do. So I think that's a really good marker to sort of understand how much value we are generating for the state of Alaska versus how much we cost. We truly are a profit center for the state. Our stewardship now requires us to really fulfill 2 roles. Not only do we have to have that long-term view to protect the principal of the fund, we're also now being asked to provide that predictable revenue stream to help balance the state's budget. We don't, no, that's okay. We can go to the next page. I think that those 2 roles, it's really important to understand sort of the conflict that those 2 roles, the short term and the long term, can be at times. But our job really is to invest and to make sure that we have the resources we need to be able to do that. And in conclusion, I would just say that there's a lot of information on our website. There are videos. We just recently published the Alaskans Guide to the Permanent Fund. We have a lot of financial information. You can see the 11,000 plus stocks we are invested in, our annual report, trustee papers. So I encourage you to just spend a little time surfing our website for a lot of information. So with that, Liz, I'm going to, hopefully we have some questions there. I didn't see any really pop up as I was going along, but happy to answer a lot of questions.
Yeah, thank you so much. We'll give Ms. Rodell a virtual round of applause. Thank you so much for that very informative presentation. I'm looking and I don't see any questions, but we want to open it up for our attendees. If they have any questions, go ahead and type those in the chat box. I found it particularly interesting, the part where you mentioned sort of the change in role for the fund, now supplying about 71% of the state's revenue generation. And I was curious, I know this is kind of a broad question, but how that may have influenced the investment strategy for the fund, now stepping into that role as being such a revenue generator for the state.
So far, it hasn't required us to change our investment strategy. And it's because of the discipline that's being shown around that expectation. The POMV calculation is on a 1-year lag. So when we close the books on FY 20, we know to the penny what the percent of market value draw is going to be for fiscal year 22. And that's an amount that'll be drawn out over the course of July 1, 2021 through June 30th, 2022. So Department of Revenue is our partner in this. They're very good at forecasting their cash flow needs and letting us know the timing of when they might need various cash flows, and we have a great deal of coordination on that front. I think the challenge for us is if we start to get back, if we get into a period of uncertainty for different proposals, and it no longer is just that known amount that's going to go every year. Because when we know the amount we can invest to that amount, we can plan for that. And we haven't had to adjust our our strategy. We don't make any spending decisions. The only spending decisions and I would argue we don't even make them in some ways, but our board builds our budget we build our budget from the ground up. We start at zero. We look at what we think we're going to need over the next year, and we build it from the ground up. We look at various business plans. Should we be building internal capabilities in some ways? Do we need IT resources, that kind of thing? But all of that goes then for the legislature. They are the appropriators. They decide the spending. So, when we look at the revenue sources book and our role in it, we can see the decline of the other revenues, which means that the percent of market value is becoming such a bigger and bigger chunk of the overall revenue expectation for the state. How they decide to spend that revenue. And that's the challenge for us, is that we are hoping to stay in and not provide any more revenue than we already are. And they're going to have to make the spending decisions around that. It's a tough spot to be in.
Sure. Yeah, because if the legislature were to change that percentage of market value, for example, would that mean that the corporation might need to change strategy to like higher yield investments, for example?
Well, and that gets to the difficulty in it, because you saw from Callan's projections, the higher yielding investment asset classes are going to be the highly illiquid, long-term, locked up asset classes like private equity. It's not the highly liquid public asset classes like stocks and bonds. And so there's only so much you can do on that. And if you are taking more than 5%, which right now has an effective rate of around 4.5, 4.6%, that's slightly above the forecast on the left, the FY21, FY30 forecast of 4.5% real, right? So they're taking about everything, right? And the whole beauty of percent of market value is that it smooths it out over time. So you might take more, you'll see this growth in fund values. You might take a little bit more than you're keeping up with, but then you look at in the out years, and if the fund is shrinking, you're having to take less and less because that value is reduced. And part of the way you can see this is how we ended up in some of the years in the history and projections, that calculation, you'll see the market value at the end of June 30th each year. If we ended the fiscal year today at 72 billion, that market value gets boosted. But if we had ended the fiscal year a year ago on March 31st, 2020, we were at $60 billion. And you can imagine how that would have shrunk the calculation for the percent of market value. So it is designed to sort of slowly expand, slowly contract. And you might have $100 million, $200 million adjustments, positive or negative each year, but you avoid the huge boom bust cycles that we have seen with oil price volatility, production tax volatility, things like that. And that is an environment that as a state, we're not used to budgeting into, but they're learning.
Fascinating. I don't see any other questions in our chat box. Thank you so much for your time today, Ms. Rodell, and taking time out of your busy schedule to go over all of this information with us. And as Ms. Rodell pointed out, some great resources at the state level, at the corporation level, for digging deeper if anybody would like more information. We'll make this presentation available on the Alaska Press Club's website as well for further review. And I just want to point out, we do have a brief survey for all of our attendees. If you have a minute to just fill this out, it really helps us us to inform our future presentations, to kind of orient the direction that we take some of those funding resources that the Press Club has for professional development. So we greatly appreciate any feedback that you might have for us. There's a link to that form in the chat box for all of you right now. And for anybody who may be watching later, you should be able to find that as well on the Press Club website. And as promised, we do have a brief trivia question for everybody for a chance to win some snazzy Alaska Press Club swag. So our question today is, what year was the Alaska Permanent Fund created? We'll see who can chat the correct answer first in the box. That will be our winner, who will take home some Press Club swag. We will mail it to you. So what year was Alaska's Permanent Fund created? This will test our listening skills today, if anybody can recall. Ms. Rodell spoke a bit about the debate leading up to the creation of the Permanent Fund, some of the first investments by the fund. We'll give a minute there for you to chat in the box. Do you have any guesses there?
You can guess.
Do I need to throw in my guess?
Yeah. Any hints here? We talked a little bit about some of the timelines leading up to the creation.
Anybody we celebrated a bicentennial as a country that year.
Oh, all right, Emily, thank you for your answer. 1976. Ding, ding, ding. We have a winner. So thank you, Emily. We will we'll be in touch with you about swag and where to send it to. And oh, there we go. Yep, on the slide there. 1976. Well, thank you all. Thank you to our attendees. Thank you to our presenter today. We really appreciate everybody joining us to talk about this important subject. And once again, please do give us your feedback. That helps us to inform future presentations. And thank you again to Ms. Rodell for your time today.
Thank you.
With that, we'll say goodbye to everybody. Wish you a wonderful day today. And thank you all again for joining us. We really appreciate it.